Today's Animal Spirits is brought to you by Kraneshares. Ben, yesterday we had a conversation with a portfolio manager who manages international stocks, emerging markets, and we were talking about just at the end of last year, a real crescendo of investors just absolutely throwing in the towel and say it's been 15 years, it's never going to happen. And we spoke with Brendan Ahern from Kraneshares about KWeb and probably sometime last year. And Brendan was, I don't know if I'm misremembering this, but borderline despondent.
It was about the lows as low as it could have been for sentiment, and since then international stocks have done well. KWeb is up more than 20% this year. Chinese stocks are doing well, big time comeback. I guess it just goes to show you that sometimes the sentiment stuff is correct, right? We just had to keep going a step lower, a step lower, a step lower.
You know, it's darkest just before you die. But now there's light. Now there's light on international stocks. And if you want to take advantage of the sentiment change and get exposure to the Chinese tech giants, KWeb is the way to do it.
Yep, Kraneshares.com to learn more.
Welcome to Animal Spirits with Michael and Ben. Ben, it is really nice to be back in our natural habitats.
Yes, we did live shows in the elements last week from our hotel, at the stage. We were all over the place.
I learned that bombing in front of you, if you don't laugh at a joke, no big deal. If a whole room full of people or group of people, what do you call those people? A gaggle of people, just blank stares, not so great. Not so great. I tried to do some crowd work, didn't go over so well. Here's how I'm feeling my middle age. So I turned 40 yesterday, and I introed I emceed a group of speakers, and one of them was our friend Doug Bodenparth. And I said, Doug, watch this. I'm going to say a joke that nobody's going to laugh at. There's just going to be blank stares. So the topic, the panel was around generational wealth. So I got up there, I'm on the mic, and I said, generational wealth, what is it? Ali G was 20 years ago. Nobody, except for Doug's wife, who went like this, put her face in her head. Who put her face in her hands and just shook her head. Not a single response. So I called you out yesterday for telling a reference 20 years old. We can't do that anymore. Doesn't play.
I know. Young kids these days don't live and die by movie quotes like we did.
Nah. And you made a good point. It's because movies aren't as quotable as they used to be.
They really aren't. And people have moved on to memes. Memes is the way that memes are the new movie quotes.
It's true.
Right?
So here's all I'll say about my 40th birthday. I have not done a ton of reflecting. It's a round number, a milestone birthday. But one thought that I had was...
You don't want to do a tweet thread about 40 things you've learned by 40? Okay.
Nah, I'll skip that. But now I do feel a little bit middle-aged in the sense that I've got 20 good years left. Right? Ish, maybe. Not 20 good years, but I've got 2 blocks of 20 years, maybe. I've got 40 to 60. Assume that 60 will stop working, give or take. And then 60 to 80. I mean, nobody looks forward to 60 to 80, right?
No, once you get there, you say, oh, well, 60 is the new 50. Or do you talk yourself into it? True. People living longer these days. You'll have robots helping you at that point.
So, well, Barry's in his 60s, and he definitely feels great. I don't think that he feels like he's done.
He was frolicking in the pool with us last week in Miami like a young buck.
He jumped on Chris's back.
Yeah. Speaking of Barry's got a new book out.
He does. So Barry wrote a book. We'll have him on the pod in a few weeks called How Not to Invest. And always a contrarian, Barry said, this trend of books getting shorter because people's attention spans are decreasing? You go the other way. Barry wrote a 475-page book about how not to invest, per the title.
I love the idea.
And a lot of incredible nuggets. I think the book is applicable for anyone, but especially for people that are towards the beginning of their investing journey. Now, a book is never a substitute for doing, right? Like some lessons you just have to learn. But if you have these lessons in the back of your head as you get started and progress through your investing journey, you will definitely be better off.
My whole thesis on investing is that there is not one way to invest. There's a handful of different ways that you can be successful as an investor. We've talked to and met people who invest completely differently, and they've been successful. But there are only a few ways that you can be unsuccessful. I think if you realize what the unsuccessful ways are and try to avoid them, that's almost easier than figuring out like the perfect way to invest. And that's what Barry does. It's a very pretty book. Like the way that he set it up and laid it out. I told him it looks very nice.
And also,
I love the look of it.
Despite the length, extremely readable.
Yes.
Right?
And very relatable. And Barry does a great job of weaving in real world stories and analogies to help you better understand investing, which is the best way to get people to remember this stuff. So pick up a copy. It's great. By the way, how many forwards or blurbs do you think Morgan has done by this point?
I think
every new finance book is blurbed by Morgan Housel now. That's like his second job.
I think Morgan put it in his bio, retired from writing forwards.
All right.
Hey, listen,
ask him for mine.
You sell 8 million copies, people are going to ask you about a few forwards. That's what it is.
We get a ton over the years, a ton of questions from young people about breaking into finance, or how do I work for this firm, or how do I get this position? All these types of questions, right? Like how do I make my mark? How do I become indispensable? And it's one of those things where I always feel like career advice is the kind of thing where you can't give your own career advice and tell people, just do what I did.
Yeah.
Because so many times it's circumstance and it's luck, but there are things that you can do. And I think one of the things you have to do is just don't tell me what you're going to do. Show me what you're going to do. Right. And I think this has happened to us a few times over the years where we've had people come to us and just say, hey, I'm going to help you guys do this. Right. So why don't you tell Matt's Exhibit A story on how this all got started?
So I started creating prospective client decks in 2013 on PowerPoint, right? That's what you do. You create a chart in Excel, you copy and paste over to PowerPoint, you drop in your logo. And over the years, it snowballed into like Frankenstein's monster of a deck. And
how many different iterations have we done? Dozens, and I mean, it's a lot.
The reason why the prospective client deck is so important is because when you are being shown a visual, it is borderline impossible to simultaneously listen to the words that people are saying and also look and take in the visual, the data, right? So in that scenario, your eyes completely dominate your ears. What the person is saying is almost background noise. You're just looking at the visual, and it's either it's confusing, it's pretty, it's sloppy. Like it makes you feel a certain way. And when you're showing this to somebody, and it looks like we did, our deck was okay, but it wasn't great. I think we thrived like in spite of it, not because of it.
We've always wanted to make it better over the years, but we just
and it's hard. It's hard because sometimes the data is coming from different places, the sources, the charts itself. So we went through our routine audit with regulators. And at this point, we have probably over 100 slides. Now, we use Canva, so it's not like the advisor is showing the client 100 slides. That would take 6 hours. So they get to pick like their favorites. But so I got the deck back approved, and I'm looking through it. I'm just scrolling. I'm like, nope, that's it. Can't do this anymore. It's time to get serious and find some sort of graphic designer. Like, we have all the data. And if we don't have it, we could find it. What we needed was a professional deck. And literally, later that week, I get an email from Chart Kid Matt who said, hey, found you guys in college, fell in love with finance because of the Tom Lee episode, got a job working for Tom Lee, learned how to be valuable, and he included a PDF with 15 charts, all Ritholtz Wealth formatted. And I'm like, you gotta be kidding me. So long story short, we hired Chart Kid, as listeners and viewers of the show know. We hired Chart Kid to rebrand our deck, take all of this disparate data and clean it up and make it just stunningly beautiful.
All right, we've been creating charts for years, but they've never had the same look or feel or flow. It's just they haven't looked as nice as we'd want them to be.
So so Chart Kid Matt made our deck, he made it hum.
He just started showing up at the office, remember? And he's like, I'm going to work at the office now. And he just sort of, it was going to be kind of a part-time thing at first, right? It wasn't going to be full-time. And then we started leaning on him, and he kind of said, listen, anything you need, I am here. And he started sending off chart ideas, and then we would bounce off ideas, and he'd send them back, and he'd get it done immediately. And he
made
right
himself
away
indispensable.
became indispensable to us. That we said, now we can't live without this guy, because he's made our lives easier, and he's made our lives better in the stuff that we do and need, and we never realized we needed him till we had him.
Not only is Matt talented, but in the office, he is just like, he lights up the room. He has such a great personality. When boxes come in, he unboxes. He does everything that he's not asked to do. He's just a great person. We had the idea to turn this work into a separate business in which advisors can white label Chart Kid's charts. So the company is called Exhibit A. The URL is exhibita4advice.com. We've got over 100 charts. They're updated daily. The economic charts are updated, of course, monthly as the data comes out. And all you have to do is upload your headshot, drag over your logo. It gets color formated. Upload your compliance.
different color schemes that you can do. Yeah, compliance.
Upload your compliance language. So it's a compliance hack as well. And you've got client communications for days.
So not to brag, but over the years, I've gotten hundreds and hundreds of questions from advisors because they have to get it through their compliance. Hey, Ben, can I use this chart you produced for your blog? Hey, can I copy and paste this, or can I use it and source you? And now you can literally take the charts that we've created over the years and make it your own.
Yeah.
And use it. It's such a simple program to do it too that Matt and his team has created.
So we launched it last week at Future Proof, and the signups and, more importantly, the feedback that we've gotten over the last 7 days has exceeded expectations. So we are super excited about it. And follow Chart Kid. He's fired up. Okay.
Give everyone the URL so they can sign up.
I did, but I'll do it again. It's exhibita4advice.com. Okay. Let us talk about the stock market, shall we? Would you say Trump blinked?
I think the stock market won this round.
Yeah.
Fair? So
yeah.
we're going to be flexible on tariffs. We're going to walk back some stuff. The market pushed him, and yeah, he had no other choice. What was he supposed to do?
Well, he what do you mean he had no choice?
The market was not going to let this keep happening. Like there was not going to be no give and take.
Yeah, but he could have. He didn't have to give. Anyway, he did. He blinked. And so
no. Hey, listen, you can't argue with the stock market. It's like having an argument with your wife. You're going to lose.
All right, I'm going through Mike Sicardi's feed. He had a lot of good charts yesterday. XLY up 3.8%, best day since November 2022. Now, of course, a lot of that is Tesla, which was what, 10%.
XLY is consumer discretionary.
That's Tesla and Amazon for the most part. It's like 50%. IWM, that's Russell 2000, best day since the election. U.S. stocks best day versus internationals in more than 4 months. Interesting. The retail ETF XRT, best day since Thanksgiving. Home builders plus 3.2%, best session in 4 months. The VIX plunged to 17.5. So it is premature to say that the correction is over, because who knows, can revisit the lows. But it was a nice bounce. It was definitely a nice bounce. And this is not a victory lap, but this is part of what I was trying to say about the problem with selling out of emotion. It is the easiest thing to do. And if you sold last week or 2 weeks ago and you're now feeling regret for selling, what do you do now? And not God forbid, but if you're like, all right, I'm gonna get back in, bad decision, I'm not gonna do that again. And then we roll over from here. Do you get back out?
Yes, exactly. You can't make it all like outcome based, obviously. But if you make that decision, you have to have what's next. Like, what are our Wall Street Journal readers from last week? What do they do? The people who got out and set them out. The volatility is too much. The uncertainty is too much.
Right.
Now what? And we're talking about a week here or whatever. But I looked. So year to date, this is through Monday. The S&P is down 2%. Over the past year, it's up 10%. So I know for some people it feels like the sky is falling, but the stock market is not in a terrible place. This is nothing still.
That was the problem, is that, like, just contextual, it was a baby sell-off. Now I know that there was individual names that really got bombed out, but for the index itself, now again, the Russell was down close to 20%, NASDAQ was down more than 10, but the S&P was down 10, and the VIX was what, at 25, 26. So if you're feeling like like nervous sweating, like, and I know it's all political, so it's not the stock market itself, but anyway, rambling here, but
wait, wasn't this another like feather in the cap for diversification? Because everyone said, what happens when the Mag 7 rolls over? And the Mag 7 rolled over hard. It was down 20, 25%, and the market was only down 10. So guess what? The rest of the market picked up the slack.
True. So the wealth effect is going to be put to the test. Although I guess maybe if the market snaps back, maybe not.
Yeah, so this is Mike Bird from The Economist. He said, American households have never been more exposed to the risk of a stock market sell-off. At the end of last year, they held $38 trillion in listed equities. Stock wealth now runs to 170% of disposable income, more than double the long-term average. And he's just saying, listen, there's more people invested in the stock market. It's a bigger percentage of everything for everyone. I go back and forth on the wealth effect. Are people really selling their stocks to spend money? Is that what's been going on for this whole?
No. Nobody's saying that.
Or are you saying it's just all psychological? And but on the other hand, you have people who say, like, listen, I don't feel any wealthier just because my house doubled in value. I don't spend more money because my house doubled. So I go back and forth on what the actual impact of this is.
Me too. But even though nobody would say that, I think it's like subconscious, and it is vibes all the way down, because the only way that the wealth effect exists is in a good economy, right?
Yeah.
And you're more likely to be spending in a good economy when you're employed and you're not worried about getting fired and you're getting raises. So it's sort of circular. I don't know if it's necessarily the market and your house that's driving your spending, or it is the economy and your spending driving the stock market.
Because then you get back to the fact that we said, remember, the top 20% of households or 10% are doing almost all the spending, and they're the ones who own the stocks too. So is it only impacting that group though? Because the top 10% owns 90% of the stocks.
Right. But I do think that those big spenders are more likely to pull back, because think about how many stock-based loans there are out there.
Yeah, that's true. And you're right. Yeah, for a lot of people, it is psychological. Even if some people say, no, steady-handed, whatever, there's got to be something there. Okay, I think it was last week or 2 weeks ago, we talked about just the markets are constantly getting faster. I think we talked about that future-proof. I went over the UBS Global Investment Yearbook, which is an annual update. I think it used to be Credit Suisse. Then UBS bought them, so now it's the UBS. It's like a trade in the NBA or something, right? We're trading the yearbook from Credit Suisse to UBS. So they look at the biggest crashes of the past 100 years. They look at the Great Depression, the dot-com bust, the mid-1970s, and then the GFC. And then they look at real drawdowns using inflation, and then they look at how long it took them to come back. And obviously the Great Depression was the longest one, but each successive one gets a little shorter. And the 1970s was shorter, the dot-com was shorter, and the Great Financial Crisis was even shorter. And this all makes sense in the information age stuff, but it also makes sense in the fact that the government is just more heavy-handed when there's a crisis. And they bring it back. Because if you read about the Great Depression, the government and the Fed made it worse.
I read Herbert Hoover's biography, and he was like denying that there was even a depression.
He wouldn't he didn't say anything to the public.
Nothing to see here. Everything's fine. He wouldn't even acknowledge it.
Yeah, the government and the Fed do not come out, and they learned from those mistakes and got better. And I think that's one of the reasons that you see these crashes, these V-shaped recoveries, not last as long. You know what else had a V-shaped recovery? We'll get to later.
Severance,
big time V-shaped recovery. I sold way too quick there. I timed the market. I mistimed it. I panic bought back in. It happens.
All right. Then I assume I should pick it back up.
Oh, okay. You haven't. Okay. Okay. Save it for recommendations. I got to. Okay. So speaking of chart kid, Matt, he did this one for me. I wanted to look at Europe versus the U.S. going back to 2006, which is when VGK started. That's the Vanguard European ETF. And I wanted to look at the spread between the two of them, because as of last week, Europe was outperforming the U.S. by 18% this year.
Wow.
Maybe it's narrowed a little bit. And that is the highest we've seen since 2006. There hasn't been a double-digit outperformance by Europe over the U.S. in that time, since 2006.
The previous years are annual. Of course, 2025 isn't over.
Yes, 2025 isn't over. Just through this time frame so far, yes, 2025 is not over yet. but the outperformance we're seeing is something we haven't seen in a very long time.
All right, so let's talk about this for a second. What is the takeaway? Because people that are only US based and have been for the last decade could say, so what?
Yes, that's yeah.
I was supposed to be diversified in international stocks because for 7 weeks, international has outperformed.
So there's this great Peter Bernstein quote, and I think he's one of the people who maybe got lost in like the investing legends. I think his stuff is fantastic every time.
He's on the Mount Rushmore of finance writers.
Yes,
I know he's an investor
thinkers,
too,
and so he had this quote, and I'm paraphrasing here. It was like, one of the benefits of diversification is not just risk management. He said, diversification is also an aggressive strategy because you don't know where your next winner is going to come from. So you could look back and say, yeah, Europe is, look at what happened last year. Look what happened 3, 5, 10 years. Europe is still getting smoked. But it's the future that matters. And if Europe comes back and foreign stocks do well in the future, that's when diversification matters.
Such a good point. That's such a good point, Ben. Investors make decisions, obviously, because we don't have future performance, but they make decisions looking backwards.
Yeah.
They make decisions like, well, what would have been the best investment for the last 5 years? And I'm going to do that.
Yes. And honestly, sometimes that does work still.
Yeah.
If you would have done that,
it worked for the last 15 years with the US.
If you would have done that with tech stocks in 2015 and 2020, you would have kept doing well. But eventually that doesn't work.
I've said this before, but first level thinking really won for the last 15 years.
Big time.
I remember somebody said to me, the next Apple is Apple in 2015. And I was like, you dumb bastard.
Right. They were right.
And they were right. So I blame Howard Marks for me not owning enough Qs.
All right. Back to Mike Siccardi. He shows equity ownership by household. And this is US versus UK and Euro area. And this is stocks as a percentage of household financial assets. So that's cash, stocks, bonds, collectibles, housing, all that stuff. In the US, it's 34%, and it's been rising fairly steadily. It was down to 15% in the Great Financial Crisis. But in the Euro area, in the UK, it's only 10%, and it has basically been there since 1990. That's amazing to me how low it is there. And I told you I've done some speeches overseas before, and they've talked to me about this, and they say, listen, everyone in the past, our wealth was tied up in real estate and bonds, and that's it. We never had to own stocks. And then rates went to negative in Europe. People had to catch up, and they're figuring out what stocks are, and the foreign ownership percentage is rising, but there's still a lot of room for households to get out on the action here.
What a wild chart. Wow.
Right? Doesn't that make you kind of bullish for the future that these people are going to have to realize eventually, like, we need to own stocks?
International?
Yeah, foreign investors. It's going to happen. Don't you think?
I don't know. Why? Why does it have to? It's cultural. It's a whole different thing.
I think we get there eventually.
All right.
I'm going to translate my next book into British. I'm going to use wanker, and instead of calling it index funds, I'm going to call them trackers. And it's going to help the UK environment for investing.
All right, Ben, you love this chart from Goldman Sachs, ownership of the U.S. equity market.
Yeah, speaking of. So this one comes from Goldman Sachs, and they show ownership. And I think this is another form of diversification that is underappreciated. In 1945, households owned 95% of stocks. And I think they mostly bought and held and owned them for dividends, like GM and AT&T and such. And now households still own the stocks in different forms, but now it's through ETFs and mutual funds. And
whoa. This is I know you have to break it down somewhere, but the lines are weird here because don't households own the mutual funds and the ETFs?
Yeah, that's what I was saying. But it's a different. So in the past, they literally just owned these shares, and now, it's the households still own them technically, but they're through these different vehicles, and I think they're smarter, they're more tax efficient, and that's the point. Is that, like, I think having these diversified forms of investing is actually a good thing, that it's spread out and the holdings are in better vehicles.
Interestingly, the percentage of the market held by foreign investors has gone up a lot. It's now 18%.
It's gotten a lot bigger. You can see it really widening, right?
Yeah.
That is interesting. They just need to start buying some of their own
I wonder
stock.
if that's counted in the previous chart. So in the previous chart, we're looking at listed equity as a share of U.S. Of household financial assets. Are our stocks in that chart? Probably.
Yeah, I would think so. But if you look at people, there's the people who worry about index funds and ETFs. Index funds and ETF share of the U.S. stock market is about the same as foreign investors. So it's not, in the fund industry, it's 50% or so, but in the overall stock market, it's 1/5. So it's not as big as you think. Or sorry, 15%. Active mutual funds are still bigger than ETFs. Anyway, yeah, great chart. Robin Wigglesworth, the bond market is still not worried about a recession. So can we say that if that little freak out was the correction and yay, it's over, who knows? Did the bond market get it right? Because it didn't freak out. So they look at the high yield spread, it ticked up a little bit, but it's still way lower than it was in 2022, 2023, 2024. Even he shows the junkiest stuff. So triple C and lower is ticking up a little bit, but still very, very low spread.
So the triple C's, which again, as Ben said, is like the junkiest of the junk, the lowest credit quality. Even through this like spike, it's still below where it was for basically all of 23 and most of 24.
Exactly. There's not a lot of worry in the bond market. So I keep trying to figure out, is the bond market going to be the tell, or is it going to be the rear view mirror where like it plays catch up very quickly when the risks are actually here for a recession, when that happens?
I defer to the bond market getting it right. It's not going to always, it doesn't always, but
okay, it's possible.
No leading indicator is perfect, but I trust this more than stocks.
That's fair. I'd agree with that.
These were some things that I was saying like in the last 2 weeks that made me a little bit more optimistic than I think a lot of people. Number one, credit spreads. Number two, just where rates were. If we really were going to a recession, I don't think, how low did the 10-year get? I think the 10-year would have had a 3 handle.
Yeah, it's still above 4, right?
Number one, the VIX. And I know that there's all sorts of things about the
You just did Buzz from Home Alone there.
What'd I say?
You know where he goes, A, 2, and D.
All right, and finally, purple. I thought that the coins would have like really been crashing. And yes, they were down, whatever, 30%. But I thought...
Yeah, crypto did stabilize before everything else, didn't it?
I thought Bitcoin would have gone to like, below 70 if there was really going to be a global meltdown.
Yeah, you're right.
Now, counterpoint, one areas of the market that is legitimately giving cause for concern are the consumer discretionary stocks, underperforming the staples in a meaningful way over the last 2 weeks. That has since stabilized a little bit, but that was definitely a feather in the cap of the bears.
And talk to us next week or 2 weeks. Maybe we're rolling back over and who knows.
Exactly. Yep.
All right. Good one from Bloomberg. Private credit firms are pushing boundaries to win large deals. And we've been wondering, what are the actual risks to private credit? I think this is one of them. So they say private credit funds are grinding down margins and cranking up leverage to win business over their liquid peers. So they're saying because credit spreads are so tight, which we've said, and there's so much money, the deals are so much harder to get that they're having to use more leverage and go further down the credit quality to get the same yields. And this makes sense to me as like the people have been wondering about, well, is private credit going to blow up? And I think the thing is just you're taking on riskier loans and you're using more leverage. That's the risk of your returns being lower.
Yep.
Right. That makes sense to me as like a risk of your manager taking on too much risk instead of saying, well, the yields should be 9% these days instead of 12 because things have changed. Right. No, I still want 12. I'm going to push the limits to do it.
Yeah, I don't know if there's going to be like a blow up, a day of reckoning, as some people are rooting for in the private markets. But I think you're spot on. It's going to be lower returns probably.
All right, from Bespoke, they looked at 100 baggers over the past 25 years, which is pretty impressive because that's going back to the height of the dot-com bubble, right? Which is not a great starting point. The returns from the dot-com bubble are not great. I think it's like 7.5% per year. It's not awesome because we had that lost decade. And so they've said 19 stocks in the Russell 1000 have been 100 baggers over in that time. Monster is the biggest one. That's 1,000 bagger. NVIDIA is second. There's some surprising ones on here. Decker's Outdoors, which makes Uggs and, how do you say that, Hoka shoes?
Still they do?
Yeah, and Teva. I didn't realize they had all those.
I didn't know that.
I still haven't gone down the middle-aged dad route with those shoes yet.
Hokas?
No, still not got there. But like Old Dominion Freight and Tractor Supply, I mean, Apple's on there. O'Reilly Automotive, AutoZone. There's some surprising stocks on
Isaac
here.
Develops credit scoring and analytics software.
Right? There's some surprising names on here that you wouldn't expect.
I haven't heard a lot of these companies.
NVR, a home builder. It's kind of there's not as many tech stocks on here as you would think. It's pretty much just Nvidia and Apple.
Huh. Ben, we launched an ETF.
1 million people sent us this. This is from Eric Belchunas. VistaShares filed an animal spirits ETF and a 2x animal spirits ETF, which will hold the 5 fastest growing 2x single stock ETFs.
Oh, wait, what is it?
Yes, these things are. So again, getting back to the people who worry that index funds are going to cause problems with market structure, I think this is the 5 fastest growing 2x single stock ETFs. So this is 2x Tesla, 2x Nvidia, those kind of stocks.
When you say fastest growing, what does that mean? In terms of like assets or price or what exactly?
I'm guessing it's a momentum strategy, but yeah, I didn't go.
All right, so this is like a vol of what, 175,000.
Yeah, so this is like momentum on top of momentum on top of momentum on top of leverage, and they have a 2x one. So yeah, I don't think we're going to attach our brand to this one, but these kind of things, like when you start doing the Russian doll of these ETFs, like this kind of thing, like to me seems like it's a flash crash waiting to happen.
Yeah.
Right? I don't know how. I don't have enough smarts to know like if these kind of products could blow up, but this kind of thing to me, this is way scarier than all the money in index funds to me.
Pretty impressive that as far as my memory goes, the last flash crash in the market that was like market wide, that was 2010.
2015-ish, there was one maybe.
Remember
we had the ETF dislocation one?
In 2020 with bonds.
Yeah, but you're right. I'm surprised we don't have more of them, to tell you the truth.
Pretty impressive.
If the algorithms pull back. Okay. I still remember that. I remember that day in 2010 when we had the flash crash, just sitting at my screen all day, like, what is happening? It was a 6% down day or something, I think.
All right. Bank of America, biggest foreign selling of U.S. stocks since March 23rd. That's interesting. Foreign investors dumping our stocks.
Oh, foreign investors dumping U.S. stocks. Yeah. Interesting.
Now it's a dollar level, not a percentage. So when you correct for the dollar level, and you see that they now own 16 is that trillion? Wow. 16 wait, how is it that high? How big is our stock market?
Remember, it's 18% of the stock market. Goldman says it is $93 trillion.
Wow.
That makes sense because it's 18%.
Also, the selling of U.S. stocks.
We just fact-checked ourselves there, right?
There we go. All right. From Zero Hedge via Goldman, or Goldman via Zero Hedge, I guess. CTAs, commodity trading advisors, are short $34 billion of U.S. equities versus long $52 billion of European equities. That spread is the largest we have ever seen by a decent margin. Maybe that led to some of the reversal that we saw yesterday. Mike Zicardi tweeted that it was the biggest reversal in 4 months, or the biggest outperformance of U.S. over international in 4 months.
I got to be honest.
Positioning.
Whenever I see the CTA positioning, though, I feel like it's just telling me what just happened in the market.
Yeah, but it wasn't extreme, so interesting to note.
That's fair.
All right. Brian Moynihan was on, the CEO of Bank of America, was on CNBC, and he said, we're in this classic moment where the consumer is saying, I'm getting more pessimistic. But if you actually look at what they're doing day to day, they continue to spend, which means the economy ought to be holding up better than people think.
This is why we are the sentiment stuff, we're not believing it quite yet, because you got to watch what they do and not what they say. That's what he's saying.
We have more. Yeah, Powell addressed that, which we have that later in the doc. We have Powell stuff later in the doc. All right, somebody asked if Trump would care that foreign investors dump stocks, which was a timely question considering that we got this question like maybe a week and a half ago. And I was like, I don't know. Maybe he would like it. I have no idea. But there was an article by Barry Eichengreen in the FT, and he is a author, professor of economics. Let me just read this block. He said there are questions, moreover. So the article was, can the dollar remain king of currencies?
Okay.
He says there are questions, moreover, about whether foreign holders of U.S. debt securities will continue to be treated fairly. Scott Bessent, Trump's Treasury Secretary, has reportedly mulled the possibility of converting 5- and 10-year U.S. Treasury bonds held by foreign investors into 100-year securities bearing low interest rates. whether those investors like it or not. Yeah, I don't think they would like that. Later in the article, all right, labeling
they would sell those immediately.
Yeah, labeling the measure a user fee instead of a withholding tax would avoid violating international tax treaties, but it would fall foul of the expectation that domestic and foreign investors are to be treated comparably. All right, here's a coup de grace. Quote, this effort to limit foreign purchases of U.S. treasuries as a way of depreciating the dollar, something that Trump and his advisors evidently see as desirable, could quickly get out of hand.
So this is another catalyst for international stocks. The dollar.
Yeah, I don't know that he would view foreigners dumping stocks as a bad thing. He would say, good, they belong with Americans. I mean, I don't know. I have no idea.
True. My whole question about the dollar, and I get people worried about these trade agreements and us not helping our allies. I just don't know what steps in and takes over for the dollar that quickly. The whole thing, like this, could get out of hand quickly. What's the alternative? That's my only question.
Cardano.
There isn't. Yeah, there is none. Okay. So you mentioned Jerome Powell. He seemed to me pretty. I don't know. He didn't seem to be worried at all about the economy. He was kind of saying, "You people are worried, not me." Is that fair?
So let's get to what he said. The market rallied pretty violently after he spoke, which has not been the case for a lot of his speeches.
How did Powell put the bottom in?
The Spoke has a great chart showing S&P 500 intraday composite for Fed days by Fed chair. Powell, Yellen, Bernanke, Greenspan, and Powell's been bad. Not that the market has been bad during Powell's talk. It's not his fault. He was the Fed chair
they literally wanted the stock market to fall during 2022. They were trying to get it to go down.
Right. So Neil Dutta said that Powell did everything he needed to on Wednesday. The fact that stocks rallied on the FOMC decision day absolves Powell of taking any responsibility for the sell-off and makes it more challenging for Trump to find a scapegoat. This is not 2018 and Powell tanking the market with this, quote, long way from neutral talk. Ball is back in Trump's court. So there were some interesting quotes in the presser. Somebody asked him about the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. So Powell said, Michigan, Ben's home state, the one you're referring to, the longer term thing, we look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we have to keep that in mind.
Jerome Powell, anti-survey, just like animal spirits.
Nailed it. The transcript, great resource. They pull quotes from CEOs, CFOs, Powells of the world. This is from Darden Restaurant CEO. He said, as we come out of the third quarter into the fourth quarter and we gave you our expectation for Q4, people, even if they say they're feeling less optimistic, we haven't seen a huge correlation between that and dining out. So changes in consumer sentiment haven't necessarily translated to material changes in consumer spending. So I think as long as incomes are going up and outpacing inflation, I think they're likely to keep spending.
So CEOs and the Fed chair and everyone are basically going, hey, consumer, you're full of shit. I don't believe you. Is that not the theme we're picking up here? And these are the kind of quotes that if we did go into a prolonged slowdown, people would look back and say, see, they missed it. Right? But their point is, we're not seeing it in the data yet.
Right. And now there's so many economies in our economy. So certainly some areas are slowing down. There's no denying that. One more quote from Powell. He said, for right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and the high uncertainty, and we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
I've been pretty hard on him. I was pretty hard on him in 2022 for going so hard and cheering against the stock market and saying we want to put people out of business or put people out of jobs. I thought they kind of mishandled that, and I think they got lucky that they got a soft landing. But I think he's done an amazing job overall in his term.
Amazing.
Don't you think for all the stuff that he's had to deal with?
No.
You don't think so at all?
I think mixed. I think some good, some bad.
Okay. I I'm putting it out there now. I think he's the last good Fed chair we're going to have for a long time.
Why?
I think this is going to be a politicized position in the future.
Uh,
And you remember, Trump was the one who put him in the position. Powell's a Republican. I think this is going to be a politicized position going forward that is going to do whatever the president says. That's what people are going to look at this to. I think the independence thing is probably gone, and he's going to be the last good one we have.
all right. I hope you're wrong. Trump socialed. The Fed would be much better off cutting rates as U.S. tariffs start to transition their way into the economy. Do the right thing. April 2nd is Liberation Day in America.
That's what I mean. If he doesn't lower rates, Trump's going to get rid of him. I firmly believe this. I think there's a very high probability of that happening. If he doesn't do what Trump wants to do, he's going to say, all right, get out of there, and I'll get someone else who will.
Maybe. All right. I noticed this at the gas station the other day. Gas is under $3, at least where I am. It was $2.93, and I said, pretty nice.
It feels to me like gas prices haven't gone anywhere for a while. It's been right around there for a long time for me.
Well, look at this, the national average from Y charts. Looks like a breakdown might be coming. I know you can't do technical analysis on gasoline prices as a joke, but we're trending in the right direction for sure.
And the spike didn't last for that long from the inflation and war stuff.
And egg prices are crashing. What is this? What is the story with crashing egg prices? Was this like bird flu stuff? I haven't followed the story.
Yes, but I don't know how it fixed itself so quickly. I talked to two friends this weekend who own chickens, who literally own their own chickens and get their own eggs.
And
I think the egg thing is just one of the more rational things we humans hold on to. I think people put way too much emphasis on egg prices. That's always been my stance, and I'm sticking with it.
Wait, your friends?
Like, I literally know people who own chickens to have their own eggs. Like, can you imagine taking care of a chicken? Because I don't think that's the only reason, but that's part of it.
No, they must get some personal satisfaction out of that.
I'm sure. Would you get personal satisfaction from owning a chicken? I wouldn't.
You know, we hatched ducks back in the day.
What do you mean?
My mom was a huge animal lover, but we always had like these weird pets because we were all allergic. So we had an iguana, we had a tortoise, and one summer we hatched chicks. That was a disaster. We brought them upstate to the cabin, and they all got eaten by raccoons. It was horrifying.
It's a classic.
But no, I would not. How much does one spend on eggs throughout the year?
That's my whole point. It's
even expensive eggs.
As a percentage of your budget, it's so small, but we put so much emphasis on it. And why? Because it's a volatile series. If prices weren't so volatile, people wouldn't pay attention as much.
Yeah, I don't know. Enough about eggs.
The higher the chicks, the higher the clicks. Not bad. All right, let's talk about real estate. This is from Matt Iglesias. I thought this was pretty good. And we've talked a lot about why don't we build more housing? And I think about, and there's been all this discussion of Derek Thompson and Ezra Klein's book, Abundance. And we're going to talk to Derek, hopefully, coming up about the book. I'm going to pitch him my own stock market abundance plan. I've been thinking about this for a while. Stay tuned. But that got me thinking, why did we build so many houses in the early 2000s? Like, what was it? Was it deregulation, or was it just the fact that people were going crazy for housing because the banks weren't charging, or the banks had lax credit standards? So you look at this. Matt Iglesias did this chart where he showed mortgages outstanding as a percent of GDP. He did it by credit score. So above 740 and below 740. And you can see there were way more loans given out in the 99 to 2005 period. It took off like a rocket ship. And now the below 740 has crashed. Above 740 is down a little, but it's basically like we've decided people with low credit scores don't get mortgages anymore, right? Not nearly as much as they did. It's the lowest it's been in this series going back to 1965. So
is this good or bad?
Well, here's after the crisis, remember there was the story of the strawberry picker who made $14,000 a year getting a $750,000 loan in California. That's from Michael Lewis' book. And people thought like this almost crashed the economy because we gave out way too many loans. So then we go completely the other way and say, no, now we're not going to give loans to any people who have bad credit scores. and now they can't buy a house. So what's the better environment? There's obviously needs to be a middle ground, but this is the kind of things that we do. We go way to the extremes. Let's give everyone a loan, or let's give no one a loan.
Right.
And they're both stupid, obviously,
Right.
but one leads to the other. And I just think the great financial crisis totally screwed up the housing market for years and years to come, potentially decades. And I know
this is like the story of the economy is like things become too lax, there's a bust, and then the bust determines policy, probably to the detriment for the next 20 years.
yeah, we have too much regulation and that leads to too much deregulation.
Right.
And then we go back and forth and there's never a good middle ground. I guess that's the point, is we're never going to have that. This is interesting from Rick Palacios Jr. At John Burns. He looked at Lennar, which is a home builder, and he looked at their sales incentives on home deliveries as a percentage of revenue. And in the early 2020s, it was very, very low because they didn't have to incentivize anyone to buy a home because rates were so low. Now it's shot up from, 1.5% to 13%. So they're having to offer lots of incentives, meaning we're buying down your mortgage rate, or we're giving you some sort of deal or break, or it makes sense because like they have to sell their homes, right? They can't just sit on them. Like a homeowner can wait. Home builder cannot just sit there and wait. But my question is, if we ever wanted to get to the point where we could, like we said, all right, some politician finally takes it up as an initiative, we're going to build more homes. Would the home builders be able to do it? Like, would they even want to take part in that without getting some sort of guarantee from the government?
I'm out of my depth. I have no idea. I don't know. What I do know is that these stocks are getting smoked. KB Home is in a 40% drawdown, and Lennar is in a 35% drawdown.
It makes sense. Rates staying this high for this long, these stocks had to get hammered eventually, right?
Actually, I was listening to on the Quarter app this morning. This is how they open. This is KB Home. Consumers are continuing to cope with affordability concerns and uncertainties around macroeconomic and geopolitical events. As a result, consumer confidence has declined sequentially each month for the past several months, and home buyers are moving slowly in making their purchase decisions. While longer-term housing market conditions remain favorable, driven by demographics and an undersupply of homes, demand at the start of the spring selling season has been more muted than we have seen over the past few years. As a result of this softer selling environment, we are lowering our revenue guidance for fiscal 2025.
30-year mortgage is still 6.8%. I can't believe it's lasted this long. I can't believe it.
This is an example of, the consumers are under pressure. It's not all vibes. I mean, some places are, right? Like
Right.
Doherty's, like they're still going out. They're still spending money at the restaurants. But the home builder economy is clearly in a recession and has been. I know 2022 is a weird year where home builders were the only game in town because there was no supply in the market. But there is an ice patch in the home builder market.
So there was this meme going around during the COVID crisis. It was April, and it was like something like 13 million people had lost their jobs or something. And it was a picture of Jim Cramer with that headline, and behind him, it was like stocks are rushing back to all-time highs. And everyone said, like, this is crazy. Millions of people are losing their jobs because of the pandemic, and the stock market is
I forgot
like
about that.
huge disconnect. During the next recession, that's going to be the housing market. And it's going to be so weird to people. There's going to be a ton of housing market activity when interest rates fall because of the next recession. And there's going to be lines out the door for housing. And people are going to go, how is this happening during a recession?
Yeah, I think
that is
right.
going to be a thing.
Yeah, I agree.
It's going to be bizarre.
Yeah, that's a good call. All right. We got some IPOs coming up, Ben. eToro filed yesterday. StubHub. We haven't spoken about them in a while.
You should short that one out of principle from day one.
All right. So Axios reported StubHub reports a $2.8 million loss on $1.77 billion in revenue for 2024 compared to a $405 million profit on $1.4 billion-ish in revenue in 2023.
So these companies, after a certain point, just couldn't wait any longer.
The big difference was sales and marketing, so I guess they could that's a lever that they could pull. StubHub had more than 40 million tickets sold on its platform last year by more than 1 million sellers. I feel like I would have guessed way more. 40 million seems like a low number.
It does when you consider how many people are at these games and how much you'd assume these tickets are changing hands.
Right?
I kind of agree. That does seem low to me.
Okay. The big one, Klarna. And there was a lot of memes last week. So Klarna is the giant buy now, pay later company. And this was all the memes. Klarna said in a press release that DoorDash customers will be able to pay in full at checkout, split payments into 4 equal interest-free installments, or defer to dates that align conveniently with payday schedules. So,
wait a minute, before we get into the memes, whatever happened to these buy now, pay later things being a 0% interest rate phenomenon? Was that the idea? Like, once rates are 0% anymore, these companies are going out of business. Everyone was saying it at the time. Like, there's no way these companies can survive higher rates, and they obviously
yes,
have.
they can. Yeah, we'll talk more about that in a second. First, the memes. All right, person of swag tweeted a picture of
Dave Ramsey.
My God.
Dave Ramsey.
No, it is Dave Ramsey. It took me a second.
Okay.
Middle age. Okay. So a picture of Dave Ramsey at his desk with the caption, "What do you mean you have $11K in DoorDash debt?"
Not bad.
Pretty good. Somebody quote tweeted the announcement and with a picture of Jeremy Irons from Margin Call and said, "We are selling pad thai in installments to willing buyers at the current fair market price."
It's good.
Very good. Lastly, there's one with Christian Bale as Michael Burry. Quote, "They're called chimichanga default swaps."
It's pretty good.
Pretty
all
good.
around. Is this more of a publicity thing than anything? Who's this for?
It's nothing. It's nothing with nothing. Like who's really going to use this? All right. So Affirm, I looked at their recent call. Affirm has 21 million active customers, and their gross merchandise volume grew 35% year over year. Pretty good. From 7.5 billion up to 10 billion. If you look at delinquency, right, to your point, Ben, about this being a zero rate phenomenon, delinquencies are nowhere. It's under 3%. Really nothing to see.
Do you think people just got used to using these programs? How are they still growing?
So they're huge internationally. Like buy now, pay later is not a new thing. It's just new to us or new-ish. All right. So Mark Rubenstein, who writes a Substack called Net Interest, which is phenomenal. I pulled out 2 nuggets that he said. All right. Currently, 99% of consumer loans are paid on time. Okay. Although it's the 1% you have to be careful of. Klarna mitigates risk in a number of ways. Average loan duration is 40 days.
Wow.
40 days compared with 2.9 years for a typical U.S. personal bank loan, which means the company can turn over its portfolio very quickly. Last year, it originated $56 billion worth of loans, of which only $8.5 billion remained on its balance sheet at year end. That's pretty incredible.
So they're effectively like a payday lender almost in terms of duration.
It's quick. Listen to this. Like, oh, Klarna's going to crash the account. Not Klarna. Buy now, pay later. People are going to take it. The average balance per active Klarna consumer in 2024 was $87. Okay? $87 compared to an average balance per credit card of approximately $6,730 in the US.
So do you think in the next recession, we keep trying to guess how these new companies are going to do in a recession. Does this stuff fall off a cliff or does it actually increase? Like, do people use it more in a recession to like help them get by?
Yeah, I would think.
And then the default rate just goes up.
I would think that's the path.
$87. That's hilarious.
Yeah.
Yeah, you're right. It's tiny.
Come on.
But I kudos to these companies for continuing to grow. Again, as everyone mocked them, saying this is a 0% interest rate phenomenon, never going to work.
Now, again, I'm a bit over my depth because I don't know exactly how it works. In a recession, credit card companies are like, good, we'll loan you money, 29%. Right? Like that's the price. A lot of you will pay it. Some of you won't. I don't know exactly how it works in terms of like credit availability with the buy now, pay laters. Do they just like not extend it? Right? Is there a way for them to like have the data on you as your credit profile and pull back? I'm pretty sure that's how it works, but I'm not 100% positive.
Yeah, they might not have to worry about it as much because the balances are so low, right? And it's just more of a quantity and not quality. I don't know. All right, from the FT, I think young people never stood a chance, and I'll get into the reasons why. So they look at...
When you say young, what are we talking about?
I think Gen Z-ish, and I think really, I feel for anyone who lived through COVID in high school or college. I think they got majorly screwed. I can't imagine having those 24, 36 months disrupted at that age, considering like the amount of just when I was that age, I was so carefree. I didn't care about anything. There was nothing in my life that mattered. I had no responsibilities. Even with school, I didn't, whatever, it's school. and so going through that. So
wait, hold on. I just want one thing. I don't think I put this in the doc, but I saw a tweet last week that I completely agreed with, and this is very personal. This is not going to be for everyone, but for me, it rang very true. My childhood, call it, I don't know, before 20, was way more stressful than my adulthood. And that's because my adulthood has gone well. My childhood was a bit rocky. But I feel like obviously there's different levels of stress and responsibility, but being a kid I thought was hard.
Okay. I don't know. For me, it was, I always thought it was kind of, I just never worried about anything. I think that's just my personality too. I'm kind of but I don't know. It was once I had to like the end of school and then I had to figure out finding a job. That's when stress hit me. Like, oh my gosh, maybe I should have been paying more attention and doing stuff. But they show, and I think this is a social media thing too. Confidence in the judicial system is crashing. Trying to find good affordable housing in the city is crashing. Confidence in the national government, satisfaction with your life, expectations of your life in 5 to 10 years, experience of stress. So all these other things are crashing and stress is going up.
But wait, if you looked at other age groups, I bet it would be the exact same, more or less.
But can't
you think this is unique? You think this is unique to young people?
I think a lot of it is, and I think you could boil it down to 3 things: COVID, social media, cost of housing.
I agree.
That's where I think, like, on the one hand, yes, every single generation that's come up has had their problems. But I think that if you just throw that stuff at young people, I think they do have a legitimate gripe of getting out of school after living through COVID. Young people took it on the chin to help old people. Social media, growing up in that age, you never had a chance to live a normal life or not be like completely stressed out and anxious about the world at all times. And then the cost of housing. If I was 25 today and looking at trying to find my own first house, I'd be so mad at the world.
Yeah. You're right.
So I think every generation has something, but I do think young people these days have a legitimate gripe. How's that? Even though, if you look at from The Economist, Gen Z is making way more money than any of the other generations before them. And I still think they have a legitimate gripe.
Agreed.
All right. Good chart here. So this is from Chris Freeman. He says the middle class is shrinking because many people are getting too rich to remain middle class. And I got a theory to test out on you. So it's showing that since the 1970s, people in the highest income, and that's earning $100,000 or more in 2022 dollars, so this is adjusted for inflation, has gone from 13% in 1967 to almost 38% now. The middle class has gone from 55% to 39%, whereas the low income class has fallen from 32 to 23. So a lot of people in the middle class have moved up to the upper class. All right. Do you think people as a whole, society, would be happier if instead of moving from middle class to upper class, we had more people move from lower class to middle class? If the middle class would have gotten bigger instead of the upper class?
Oh, yeah, no doubt.
But I think this is also getting back to Josh's point a few weeks ago about like everyone is rich now. This is also why people who are rich aren't nearly as happy as you'd think they should be, because there are more people who make more money these days.
Yes. Well, to that point, Daniel Crosby tweeted, or maybe put this on LinkedIn. I love this. So true. He said, the Joneses aren't that happy. We think they are. Their curated Instagram life, their new Tesla, their enviable vacations, it all screams success. But here's the truth. Chasing what they have won't make you happier. It'll make you miserable. And then he goes on to cite a study that materialism feeds on possessiveness, non-generosity, and envy. You work harder, buy more, but happiness never arrives. You just move the goalposts. You can read more about this in his book, The Soul of Wealth. Now, listen, I understand when I say that, people are like, give me a break. Like, boo-hoo. And right. I don't think I'm not saying that you should have empathy with the Joneses. I'm just saying people are chasing something that like they think will be fulfilling. And it's a message that is really unpopular. Nobody wants to hear this. And I don't want to like preach this. I'm just saying it is true.
No. So I'm rereading this right now for some reason, the Steve Martin book, Born Standing Up. And he talks about how in the late 70s, he was at the top of the world. He was the biggest stand-up comic in the country, probably the world, selling out arenas, and he was miserable. And he talks about it. He's like, listen, I was miserable, and I know I shouldn't have been, but I still was. And he was like depressed. He's like, everything I ever wanted, I got, and it still didn't make me happy. And I had to so he walked away and had to find something else to make him happy.
That's it. That's why I think why so many famous people or celebrities end up offing themselves, because they finally get what they think they wanted all along and they still feel empty. It's It's like, well, if this won't make me happy, what? Then literally, there's no answer.
Yeah.
And yeah, life is hard.
It's true.
Ben, movies are getting their butt cheeks kicked. Let's see. So I subscribe to a Substack by Scott Mendelson. And he said, sans 20 and 21 and sans inflation, it's the lowest total for this weekend since 2001, when the Sigourney Weaver, Gene Hackman / Jennifer Love Hewitt, Jason Lee con artist rom-com Heartbreakers popped. I don't remember that movie. Heartbreakers?
Gene Hackman was in that? Wow.
Anyway, Outdoor Nights debuted, the Barry Levinson, Bobby D movie.
Never heard of that.
Outdoor Nights debuted in 2,651 theaters to a whopping $3.2 million. Holy shit. Snow White bombed. Yeah, not a great spot for movies these days.
Prestige TV is the diversification here.
Yeah.
Right?
It's a great call. All right, I know we're getting long, but we spoke about Craig in this episode, so I just want to give him a shout. Craig Pierce is the dude behind Harriman House, or one of the dudes behind Harriman House, and they have been...
Who published Barry's book.
They have been massively successful thanks to people like Daniel Crosby and, of course, Morgan Housel and Brian Portnoy and Barry and Meb and so many others. And the reason why they won is what I'm about to read you from Craig. Craig said, I am back at my desk in England after 11 days in the U.S. meeting with existing, new, and prospective authors. On this trip, I visited Washington, D.C., New York, and Miami. I began in D.C. with lunch.
He was at Future Proof.
Yeah. And Barry's book party. We had dinner with him.
Yep.
I began in D.C. with lunch. Okay, skipping a little bit. Then over the next week and a half, I had 29 more meetings over breakfast, coffees, lunches, and dinners. The reason Harriman sends me on these trips is that we place a high value on our relationships with our authors. Video call serves a useful purpose, but nothing replicates meeting in person and building relationships. Maybe this is more important than ever with the expansion of AI. One way to be sure you're speaking to a human is to be there in person with them. And Craig is such a great guy, and he just nailed it. And it's not random that Harriman House is having all the success that they are.
Publishing my next book, which I finished the draft of last week. I'm handing it in to Craig this week. It should be published next May, but I'm really excited. It's been a great experience working with them so far. I can't wait to go through the whole editing process too.
Yeah. All right, Ben.
I got a quick just midlife crisis thing from people. I was picking up my daughter, and this is something we talked about before, but it was just perfect because I picked up my daughter from soccer, and there's two dads talking. And one of the dads goes, hey, man, how's it going? And he goes, can't complain. How about you? And the guy goes, living the dream, man.
Ooh.
I almost had to get in there with another one of them just to keep it going. But it was...
What would you have said? Another day in paradise.
All right. Good.
Wait, that was it?
Yeah, that's all I got.
And then did they just walk away from each other?
I thought they were going to self-combust. All right. Great idea from a podcast listener. Can you guys add a rating system to your movie and show recommendations on the pod? Typically, you and Mike say it's really good or really bad, but a ranking system will help us get a gauge of what you really think. A plus, A minus, or 1 to 10.
But here's a problem with the rating system. So
you don't want to get judged.
No.
I like the 1 to 10 scale because that's what they do in IMDb. I'm not a 3 or 4 star guy. It's 1 to 10. I love this idea.
Okay, but the problem is my ratings might not match up with your ratings. So, for example, we both agree that that let's say The Godfather Part 2 is like the best movie ever or up there. Or, let's use Goodfellas. How would you rate Goodfellas?
Yeah, 10.
10. Okay. See, I wouldn't. I have a different rating system than you.
Okay.
So I understand, all right, so...
Well, this guy says it can also act as a contrarian indicator for Michael's recommendations.
No, because I have a personal rating system. I don't believe in 10s. Okay. I'm a harsh critic. So
you're the teacher who doesn't give out A's then.
If there's a movie that I really like, for example, Alpha Dog, love that movie. How would I rate Alpha Dog? 7-1. So it might be confusing to the listener. It's like, wait, what do you mean you love that movie? How is it a 7-1? I love that movie. I know it's not like an 8-4. It's really like a 7-1, but I love that movie.
Here's the thing for me. If I see a movie or a TV show as a 7 or above on IMDb, I'm going to give it a try.
Yeah.
6 to 6.5, I'm okay with, especially if it's a comedy. If it's in the 5s, I'm probably out.
All right, so I'll try giving you numbers, but just no, I'm a tough cookie.
All right, so Severance had a fall off, and I said, here's my tweet from the other day, because I said Severance is in a drawdown from season 1 to season 2 because they had a couple slow episodes, and I sold too early, and I said Severance season 2 was the 2020 COVID stock market, from new all-time highs to a quick 34% crash.
It was that bad?
No, it wasn't that bad. I'm being hyperbolic here. Then when all hope is lost, there was a massive rally to end the year with an 80% gain back to new all-time highs. The last 2 episodes were amazing. The finale was unbelievable, and I'm seeing some prestige TV pushback saying like these shows are just so beautiful and like they're not as good as there's not as much substance. I don't care, man. I'm watching The Pitt and Severance and White Lotus in the last week and all had fantastic episodes. The Pitt episode with
I
the
disagree.
shooter.
I'm sorry if I just heard you. Did you reference what Derek said about the Gilded Age of movies, of TVs?
I've seen a lot of people tweeting like Severance really isn't that good. It's like what a person with 100 IQ would think a 130 IQ show should be. And like, there's some pushback.
No way. These are great. These are great shows.
Amazing. And it's one of those things where after watching The Pitt and Severance and White Lotus, it's hard for me to get into other TV shows now because they're so good. So I'm trying to new TV shows out, and I can't. So I started Adolescence on Netflix, which here's the greatest part of this show.
4 episodes?
It's 4 episodes.
Great.
Did you watch it at all?
Not yet.
Okay, here's the hard part though. It's about a 13-year-old who's charged with killing one of his classmates. And seeing him and the parents go through this, and it's very realistic and very good. But as a parent, it's actually kind of hard to watch.
Okay.
But it's very good and very well done. So that's the next one.
Did you start Dope Thief?
I did. But that's the kind of show where I'm having a hard time. It's really cool premise. I'm having a hard time getting into it because the other shows are so good. So I need
really, but it's such like it moves.
Here's the thing though, you need a palate cleanser. So you have to go from good TV show to a movie and then back to TV.
I gotcha.
So I needed a movie to have a palate cleanser.
All right, I love Dope Thief.
It's good. It's a cool premise.
The lead actor is awesome. He was in I only know him from Godzilla vs. Kong. He plays the podcaster, but I think he's been a star in other shows.
He's a guy from Atlanta.
Okay, that's right. All right, Daredevil Born Again. Quite good.
Okay. I actually watched a little bit of the first season of it. Those shows just don't do it for me.
Yeah, I know you're not a superhero guy, but Daredevil and the Punisher with John Bernthal, really, really, really good.
Okay.
Really good.
What's it on? Disney?
It's on Disney. Is it on Netflix or Disney? Disney. It's really good. I watched the first season of The Office.
Okay. And?
I watched it on the airplane. Only 6 episodes.
All right. The Olympics episode is fantastic.
Was that the first season?
Yes. 1 or 2. But the basketball episode is an all-timer. Was it not?
Basketball's funny.
I think that's one of my favorite episodes of all time.
It's a throwback. It's old, man. I think he does like the "what's up" thing.
Well, Steve Carell doesn't have Hollywood hair yet even.
What year was that?
04, 05 probably.
His hair was thinning back then.
When he's missing shots and he just goes, "What is wrong with me today?" It just kills me.
Some of the racial insensitivity training.
Yes. Stanley's going to start, obviously.
It's pretty good. I feel like that's a really good airplane show for me.
I can see that.
Because if you doze off, it's like no big deal.
The 20-minute episodes, like they fly by. You're right. Yeah, you don't need to pay attention to the plot all that much.
Okay. All right, Ben. Good to be back.
Yep.
I'm very happy. I'm not leaving the tri-state area until May, which I feel very good about.
Next week I'm going on spring break. So next week I'll be in the office. 2 weeks from now I'll be filming live from Marco Island.
Oh, lovely. Beautiful.
It's an annual trip.
Beautiful. All right.
Exhibit A for advice.
Exhibit A for advice.com. Animal spirits at thecompoundnews.com. Thank you very much for listening. See you next time.